Hello, everyone, and welcome to my channel where we explore all things related to mortgages and personal finance. In today's video, I'm excited to share with you all the information you need to know about reverse mortgages. I'll be talking to a reverse mortgage expert, Earl Rose, who has seen firsthand how this financial product can be both beneficial and confusing for many homeowners. So whether you're considering a reverse mortgage or just curious to learn more, sit back and relax as we discuss the advantages, risks, and misconceptions surrounding reverse mortgages.
Well, my name is Earl Rose. I work for Guaranteed Rate. I am a reverse mortgage specialist. It's all I do. I've been in the mortgage and real estate industry since, 1979, and I still hold a real estate license, although I don't sell. We did do forward, meaning regular mortgages, for a number of years, and in 2013, I and my team said we have to decide what we want to specialize in, be it one or the other. You can't do both because they both require a lot of in-depth knowledge. And so that's what we've been doing now since 2013, only reverses. We started doing it back in 2004. And we serve the needs of the senior, and we love what we do because seniors, I am a senior. I've got a reverse mortgage. So my point is we know what's needed and we know how to explain it. And we have a very, our team we've been together since 1998. So we've been around a little while, so we kind of know what we're doing. And we've done 1,300 of these over the last 20 years, and very proud to say that we don't have too many complaints. We try to do the best we can, and typically it turns out pretty good for everybody.
Well, hello, Earl. Thank you so much for joining me on this wonderful podcast. I would love to be able to talk to you about reverse mortgages. That's something that comes up from time to time, and I will tell you, I'm not an expert like you are. So I wanted to go over some of the items, some of the things to look at. What is a reverse mortgage? What are the eligibility requirements, different types, and how you can buy a home using a reverse mortgage. So take it away from here.
Okay. Well, hey, thanks for letting me come and join in with you on this discussion. And we'll try to keep this as, how shall I say, ground level, not getting too deep, just so folks can appreciate what they can do, knowing full well there's probably a little bit more to it than what we're going to be talking about here. But just to answer your first question, you say, what in a nutshell, what is a reverse mortgage? Well, it's a specialty product that's just for seniors, and you have to be 62 years old. Typically, we have a few products that allow it at 55, but the point is we'll just use that year of 62. And if it's a married couple, it's important to note that not both have to be 62, just one of them. What it allows them to do, however, is to access in a refinance situation, frozen equity dollars that frees it up so that they're able to take advantage of those dollars to complement a number of different things. And we'll go into some of that later, but you can utilize those dollars for any purpose whatsoever. And how do you figure out, for example, and one more important thing, and there's a word used quite a bit. It's called non-recourse.
Right.
And non-recourse means nothing can come harmful to the borrower or to the investor, those who provide the dollars for this. Nothing can happen to them if the market were to try 2008 and 9, go for the worst, roll over on itself, you might say. So if something was upside down in the end result after many, many years of having the product, would they be responsible? That sort of thing. No, neither the investor nor would the borrower have any harm come to them financially. I suppose the best way to put that is if we remember 2008 and 9, and I will allude to that from time to time because it's so, we don't want to do that again. A lot of houses were underwater.
Right.
So if they wanted to sell or to move, they had to do what? If you had a 30-year conventional, you had to write a check or just wait it out, which a lot of folks did. With the reverse, these are government insured loans, FHA. So HUD actually made up the difference, and it's through the insurance fund. We'll talk about that more too, but it's really a product that allows the freedom for the senior to be able to have more control over their money, really.
So what would you say, what are the eligibility requirements? I know you said has to be at least 62 years of age, but could be 55. So what would cause that exception?
You mean the 55 part?
Yeah, what would allow for that
Oh,
exception?
and that's really going to be just there's some products out there, a few of them, and you would have to, case by case is the right way to put it, if they apply. Generally speaking, and since the product came into being in 1988, it's always been 62 and older. So just to make sure that everybody understands, that's the FHA product. The other one wouldn't be FHA, but it's also going to be probably a proprietary is what we're going to call it. So most likely into what we call the jumbo range. And we'll talk about that, I'm sure, a little bit later. Well, what's the word jumbo mean in this context? But the eligibility, well, there's going to be minimal income and credit guidelines, much, much easier to qualify for than it would be for a forward mortgage. Say the person's only on Social Security and they have a lot of equity in the home available to them. We could take some of those equity dollars and theoretically say, I'll make this up, say they've got $100,000 in equity that we could access. We can convert that to a theoretical income stream and use that as supplemental income source so they can qualify easier. So we have some far more lenient ways of qualifying than you do with a standard forward mortgage. Credit, we don't use scores. We just look at the history to see if there's been any late pays and what caused them and what's the explanation. You had a question?
So when you talk about forward mortgage, you're talking about taking out a home equity loan of credit, that type of mortgage, when you're talking about a forward mortgage, so that we understand what we're talking about here, a forward mortgage.
It's always a mortgage that requires a payment.
Okay.
Yeah, that we would call a forward. It means the money's going out. So it's an action word really. But yes, I'm glad you clarified that. Yes, anytime a payment is required. A reverse mortgage requires no payment. You can make a payment, but you're not required. Whereas in a forward mortgage, if you don't make a payment, you have two choices, make the payment or move. With a reverse, you can make a payment or not make a payment. No one's going to call you. And I was going to mention about the credit. We don't use the scores again. The only way that you would, in fact, here's something interesting. So in order to qualify for the reverse, one of the things we have to look at is what was the payment history for the last 2 years for real estate taxes? Well, if they were late because of what I mentioned before about 2008 and 9, well, that put a lot of, we better reevaluate kind of thinking in the way of HUD and everyone that runs the program. Let's make sure folks can afford the taxes and insurance because it caused a lot of foreclosures back then. And we can talk about later again about how did that all occur, but why did they make that change? Well, they had to go in and pick up the tab, you might say, and that put a strain on the fund, the FHA insurance fund. So they make sure that you've made your taxes, real estate tax payments on time for 2 years, homeowners insurance for 1 year, and of course, if you're an HOA, homeowners association, those dues have to be paid on time. You wouldn't necessarily get disqualified if you were late. So now again, we got another gimme. What do you mean, a workaround? We could still do the loan, quite possibly, if we were able to set aside a few dollars that would make those payments an escrow account on behalf of the borrower. So we can still work through that. So if someone says, well, I've been late, I can't do the loan. You could.
So while you're not required to pay back on the reverse mortgage, you still have to pay your homeowner's insurance and your property taxes, correct?
Correct. In fact, those are really the two only major ways that you can get foreclosed on is don't pay them, and eventually they'll come knock on your door and say, we've got to do something here, folks. We can't continue this way. And that would happen even if the county knocked on the door. But yes, you're right. You're right.
Okay. So what are some of the advantages of doing a reverse mortgage? I know that in my origination experience, when I get someone that's 62 years or older and they're pretty much on a fixed income, but they need cash for whatever reason, I'm always recommending a reverse mortgage, that they look at a reverse mortgage. Mm-hmm. And then I get this scary-eyed feeling of, oh my gosh, that means that the lender wants to take my house away because they've heard some bad things in the marketplace, or the brother or the sister or somebody who's had an experience with a reverse mortgage and got foreclosed upon.
You're right. And we occasionally, and we hear that less than we have in the past. I don't know why that is, how things flow, but you're right. There are people who will say, I've heard something bad. It's human nature. And I encourage folks when they say that, you're right. You should stop. Anytime we hear something that's not good about anything, we should stop and take a look at it. Now, it's up to us, the one who is hearing the story, the danger signs, to go find out if there's any validity, any truth to what they've heard. We shouldn't be leaving it up to just what I heard from so-and-so. Go find out if it's true. And I'll tell you this, and we've been doing these for, 20 years or more, and we've done 1,300 loans. Yet have I heard a challenging statement that we couldn't overcome. Well, I heard this happen. Well, we say, well, it's the Paul Harvey, if you remember who he was on radio, the rest of the story. Well, when the rest of the story comes out, you find out, oh, yeah, they did have to foreclose, but when all this other stuff happened too, and so on. So yeah, there'll be that. And I say, yes, check it out. We're not going to push anybody. We never do. Want you to be comfortable. In fact, I'm going to point this out. One of the genius, and I think a number of things in the product are genius, that this thing got put together in the 1980s, and most of the math and most of the thinking is still sound. And one of them was put a third party involved in helping the client make the decision whether or not a reverse is the right choice. And that would be a certified HUD counselor. So they have to have, and required, we can have a conversation, like you and I can talk to the client, we can explain our side of the story, how we see it, and then they have to have a 1-hour conversation with that certified counselor. And without that, we can't move the file forward. It's required so they make sure that the clients have sound mind, they make sure that they have a basic understanding of what they're doing. And then number 3, making sure that people like us are not trying to take advantage. So they call it an impartial third party. Doesn't care if they get a reverse. They just want to make sure everybody is where they should be in the transaction. And that's to what? Act as an advocate and keep maybe those who have untoward intentions out of the situation. But to answer your other question too, we get for example, can I do this with a second home? No, you can only use a reverse for your primary. It must be where you live. It's the only thing we can work on. And then we just talked about the fact that you have to have the objective advisor. But another one is I heard the lender is going to own my home. No. The only time they'd ever own your home is to don't pay the real estate taxes, for example. You're not going to do that. But you'd have to be foreclosed on. They never own the home. This is a reverse mortgage. And a mortgage is a public announcement filed with the county stating, I have a lien against my property. And the only way that lien can be removed is if you had a foreclosure or you sold the home, really. So no, the bank can never own your home. And only poor, desperate people get reverses. Well, that's not true. We have people who say, I think I need to do this because they need supplemental income or dollars for something. True enough. But I'll give you an example. We mentioned jumbos earlier in this conversation.
Right.
Well, okay. Let's talk about first, there's 2 types, and then I can tell you this quick story as to why it's not only just poor. So with the standard, what we know as the word reverse, it usually and almost always alludes to the FHA product. We call it the FHA HUD. It's the home equity conversion mortgage. Okay, that's the official word. That will limit us as to how far we can go in value of home. It caps out at just over $1 million. Okay, beyond that number, you would use a jumbo product, not unlike you do with what we call regular conventional loans. There'll be a cap as to what you have your conventional, then you have your jumbo, all right, regular loan. Same thing here. So the point is, I had somebody ask me once, why would anybody who's got a very multi-million-dollar home ever need a reverse mortgage? He lives, there's some assumptions being played there. I said, let me give you one quick example. This is a true story. The guy comes to us, he's in California, $5.6 million home. Why would he want to do a reverse? Well, he told me flat out, because I asked him. He said, I'm sick and tired of making a $4,000 a month payment on my $900,000 mortgage. I want the house to start working for me. So we did the loan for him. We put together a jumbo loan, gave him access to $2.7 million of the 5.6. Now, it's important to know, we don't give 100%, do we? Because the idea is not to use up all the equity. That space is there designed to make sure that the insurance doesn't really have to kick in and pay off, in 2008 and 9 when we're upside down. So it's to protect that. Anyway, he gets a $2.7 million access in a line of credit. We paid off his $900,000, and then he went out and bought a $500,000 second home and doesn't have a payment required on either one. and he still had $1.3 million left over that he had access to for something else. He said, I want the house to work for me. And that's it. So, I mean, the point is, there's many, many reasons for getting a reverse. That was one. Others could be, I want to supplement this to my retirement. What do you mean by that? Well, if the house has got frozen dollars in it, when we say frozen, I mean, you have a home, you have equity in it, but you can't just go tear a chunk of the house out and go cash it at the store. You have to do what? We have to create a mortgage so that you have, access to the value, the equity. So that's what the reverse does. But what we're doing is setting it up so if they want to, they could then have dollars available over here that, by the way, are tax-free. I mean, home equity dollars are tax-free. So that's why IRS says that. We don't. So they have access to these dollars. Now, when the stock market's down on the left side, they might say, well, I should take some money from over here and I don't have to sell so many shares over here. I can balance my portfolio over time. The average number is like 5 to 7 years on average that people could do what? End up they're extending the retirement dollars of what they've got available.
Another thing that you can do also on that same line, if you have that amount of equity in your home, you mentioned buying a second home, that particular person could increase their real estate portfolio by buying investment properties scot-free and then reaping the benefits of the rental income that comes every month on that property. So you can almost multiply and leverage that appreciation in that home.
Absolutely.
Good idea. I think I have a good idea here. I'm thinking about me.
Well, isn't that kind of fun? Because it kind of gets you going, you go a little further. And that's a good one. That is a good one.
That's a good one.
Yeah.
What are some of the other reasons that people want to do a reverse mortgage if it's not to buy investment properties or to increase their retirement? What other reasons do people utilize the reverse mortgage? In your experience?
Well, you can use it for any purpose. In other words, there's no book that says you can only use it for limited things. So it could be the kids need a hand. It could be that you simply want to have access. So as the future goes forward, and as we know, the older you get, your health, your bills, let's face it, you go to the doctor more. I don't know. But anyway, things like that, just available to them to have it so they can utilize it for anything they want to use it for. Now, here's something else that's interesting. And I, again, didn't want to get way deep, but I usually get people to kind of perk up on this one. We mentioned that we would take this frozen equity and we would make it available to take as they wish. You can take it out in a lot of different ways. There's no set way to do it. So there it is sitting there. But while it's sitting there, this is the part that really gets people wiki. I have a reverse mortgage. I have had one for years. And this is how we use ours. So you've got that money sitting in there. You can take it out. You know that. So you can take it out and then you can put it back. So if I had a client, for example, so this line of credit is what we call revolving. You can put money into it and you can take money back out whenever you need it. You can't do that with a standard 30-year conventional. If you pay it down, pay the balance down, the only way to get that money back is to do what? Go get a refinance it again. Over here, you can pay that balance down if you have one. You can pay it down, put it back in that line of credit, and the money doesn't stay static and it doesn't stay still. It will actually grow tax-free. And that really stops everybody right there. Wait a minute, you were just talking about a mortgage. First of all, how come it is I don't have to make a payment? I'd like you to back that bus up for just a moment. How come I'm not required? Who are these guys that give me the money and they don't care if I make a payment? That's where the 𝐭𝐡𝐢𝐤𝐞 comes in. They think there's one there. So let's do this. I explain it this way. Those folks that put the money up don't put all their money in here, but they like the fact that the money's here for these reasons. Think of yourself walking into the bank. You have the sign that says certificate of deposits available. Well, we know how that works. You give them your $3,000 or whatever. They give you 3%. You come back in 2 years and you cash it in. Ah, that's easy. Well, that's how these investors look at a reverse mortgage. They make the money available, but now get this. Remember we said in the very beginning, it's a non-recourse loan. That means that even in 2008, 9, and it happened, the house was upside down due to the market, not only was the borrower not held responsible for the fact that it was upside down, but neither was the investor. So they look at it like a certificate of deposit. It's insured. So they put the dollars up to make these loans available, knowing full well that in 5 to 7 years. Now there's another one for you. It's an average number. The life expectancy of a reverse is 5 to 7. It's an old number. Why is it that? I thought you said I could live here till I'm 150. That actually is the end date. You can, but the average is 5 to 7, and that's why. I'm sick of snow in Minnesota. I'm moving to Arizona or Texas. All right, my wife passed away. I'm going to go to a different, life changes, and we don't expect that, but it's going to happen. So the investor knows that the average is going to be 5 to 7 years, and they're guaranteed, because it's insured, to get not only the money they put in, but the interest back, even if the market were to go south. So they look at it the same way we see a certificate of deposit. So there's no hook here. They're both protected. HUD figured that out when they designed the program back in the early 80s. Does that help people to understand why they don't need to make a payment?
Absolutely. I mean, I'm the thoughts and all that, those particular ideas are coming into play with me in my situation as well, because I can apply. I mean, I do qualify for a reverse mortgage, so I'm going to have to talk to Michael about that. But it sounds like a really great product. So tell me, what else can you do with a reverse mortgage? I heard that you can actually buy a home using a reverse mortgage. Is that true?
Absolutely. Since 2011, it took them years and years to come up with it, but they modified it. Again, the program came into being in 1988, and it took many years before they actually came out with the purchase side of it. And you're right. What's great about that purchase side is this. So we'll use an example. The folks have sold their house. I don't care where they are, but they have $300,000 in their hands. Now they're selling for a reason. We don't know the reason, but we're going to assume they want to move someplace either nicer or whatever. But they find they can't find anything at $300,000 because nothing as nice as what they just sold. Now, on average, and again, we have a table that is able to show at how much does each individual qualify for, and it's based on age. We'll talk about that for just a second. How do I know, or how much this person needs to come to the table with? It's important to know. He's going to sell his house and come out with 300. Is this enough to do what he wants or she wants to do, right? So the table, which was designed back in the 80s, remember that, and we'll talk about that history a little bit too, because I think that's helpful to understand where did this product come from and what was the evolution. But we're just going to, for the moment, just state it that we said the minimum age is 62. The chart goes to age 100. And even though you lived 110, doesn't matter. The chart just gives us something to go by. Mm-hmm. So if you're older, you can access more of the equity. Why? Well, if you're 92, you're not, by the chart now, not deemed to be alive, but for 8 more years. Where at 62, you got 38 more years. So they want a bigger equity spread, want more equity left after they provide the dollars. So go back to the purchase. This person is 72. He gets $300,000, and roughly speaking, they have to come into the closing with $300,000, and they could buy a $600,000 home, roughly speaking. Okay, these are just averages. $300,000 allows them to leverage up. Maybe it's a $600,000 home. What did they just do? Well, they didn't want to move there and incur a greater payment, or any payment really, because remember, we're trying to balance our retirement portfolio. But this allows you to leverage the cash that you have available to get you into maybe even a nicer property or location or whatever it is that you think you need. But you find that I can't find anything. I was going to pay $300 cash and I didn't want a payment, but I can't buy anything at $300 that was better than what I had. So for the real estate agent who's looking at a client, and again, $300, I'm just making the number up, guys. It could be any number, but whatever that number is, and that person qualifies for reverse, they could buy more than the cash available. It increases or leverages your buying power and still does not require a payment.
That's incredible. So a person, just as the example you gave, can use that $300,000, buy possibly a $600,000, put down to $300,000, and not have a payment on that $600,000 or the remaining $300,000 loan.
Correct. Right. They could make a payment, but they don't have to.
Right, but given your scenario where the prospective buyer did not want to make a payment, well, they wouldn't have to make a payment if they got the reverse mortgage. Of course, they have to be eligible based on the reverse mortgage criteria, but they could utilize a reverse mortgage by putting $300,000 and still buy a $600,000 home and not make any future payments on it.
Correct. I'll give you one real story. Real quick. He's the top cop in Minnesota. He's retired. He was the head of everything, right? And he said, "I'm so glad I met you." The builder said, "Come see you," and we did. So they bought a $570,000 brand new home. It fit their dream. They're leaving where they were, big house, down to this one. It's perfect. He said, "We had the cash. I had to take it out of my retirement to do this, but we could have paid cash for this $570,000. But we only had to come in with $235,000 in his case, his age. It came at $235,000, and I left the rest of the money in our investments." This is about 6 years ago. And he was just so tickled. He said, "I have been listening to the negative, and I'm so glad we found you," because he said, "Now we found out the truth about reverses. Earl, you got to get out there and tell everybody." And I said, "That's what we do."
Well, that's one of the reasons I wanted to have you on, is because I get a lot of questions about it, and I want to be able to provide good information for my clients. But I know the positive things about reverse mortgage because of you. But I wanted to get more exploratory as to what it is about reverse mortgage and to combat some of the negativism about it, because a reverse mortgage has its place, and FHA HUD would not be backing this if it wasn't a good product. So tell me a little bit more about how does one qualify, or what are some of the criteria that you have to ask, the questions that you have to ask to see if someone qualifies for a reverse mortgage. For example, you mentioned age, you mentioned what the market value of their home is, and how much do they owe on the mortgage, if there's any. But expand upon that information. Or that
Sure.
question.
Okay, so first of all, what I do when the client calls, I quickly gather their birth dates. Obviously, we just talked about the chart, so we can qualify from that standpoint. And then I'm going to ask them for their street address, because what we're going to do is go out and do market research, usually from anywhere up to 6 different value sites, and then we average the numbers. Amazing how well that works for us to get us, as close to the real of what the value might come in at. So we have the birth dates and we have the value, and then we want to know, for example, do you owe anything? So if they don't have a balance, then we know that they're going to get full access to what we make available. So to qualify, again, it goes back to, the credit history is one thing, but it's just the history. It's not the score. If somebody said they had a 550 credit score, that doesn't drive it. What does it makes us go find out what caused that low score, right? Was it medical? Was it something that was beyond their control? Those sorts of things can be then, you can disregard them. So we have to analyze the file, case by case basis in that standpoint. So, and then what we do then is we prepare a full proposal that tells them what the benefits are going to be, what the costs are. The costs are important. We're going to cover that today too, because that throws a lot of people off. The costs are so high. Well, we'll talk about how do you rationalize, having higher cost loans, and what does it do for you? But to go back to that, talking about, and you have to have, if it was a married couple, it's 889. It's 529 if it's a single person. So it's just mom or dad left. What we have to show is at the end of the month. So let's say his Social Security is $2,500 a month or something. What we have to subtract from that $2,500 is going to be 14 cents a square foot for maintenance of the home, real estate taxes. These are all done monthly. Homeowners insurance. If there's HOA, then any credit card payments or car payments, you subtract those from that dollar amount. And if you're left, in this case of a single person, and it's $529 left, well, they're in. We qualify. So we call it residual income. You think of it when you're doing a standard one, we'll call it, or forward. It's going to be like a 41% debt to income ratio. We just use residual. If you have that much left over, you're in. I mentioned earlier, said, well, we could also, if they have some dollars in the, the equity line that we're going to create for them,
right,
we can convert that to a cash flow too. And that would add to it. But again, it's, they've come up with, ways where we can not manipulate, but massage it. How's that? And get it to work a little easier than you can with a forward or standard loan.
So when one does make application and you determine that they do qualify and you're doing how long does it take from the time that a person applies to the time? I know that the time that they actually go to closing to sign all the documents, isn't there an appraisal that's required, or do you go based on what the county has it assessed?
No, there's an FHA appraisal that's done. Yes. So you do you have to have the signed application, and that the counselor would give a certificate, and the certificate says we've had the talk and everybody's good to go. Those two signatures, those two documents allow us to order the appraisal and order the title work. Now, if the file doesn't have any, let's say, particular hiccups, for example, somebody calls, they have a condo. Well, is the condominium association FHA approved? If it's not, then we find out, can we do what we call a single unit approval, just the one we're looking at? Or do we have to go into the whole condo association, approve the whole building, So those are the ones that would take a little longer because we have more paperwork we've got to go through. On average, though, if it's just you say, I've got a single family house, nothing weird, I don't have any problems, nothing to fix, you might say, you could say 30 to 45 days. Anything beyond that would be because we have some file complications we'd have to iron out for them.
So what are some of the documentation you would require an applicant to provide you?
A copy of driver's license, copy of Social Security, a copy of their Social Security award letter. If we need them, if we don't need the bank statements, if we need them, and we would only need them we have to document, get this, I love this one. You get Social Security from the federal government, but we still have to show that you got it. I know, I get a kick out of it. It just seems like somebody can trust somebody, but that's been around since about 2018. But the point is we have to show that, okay? So it's very limited documentation, doesn't get too carried away. And we're looking at like the assets, if they had a 401k or an IRA or something like that, well, we don't necessarily have to have them provide documentation on that unless we needed it for this asset dissipation. So it's pretty easy documentation.
Okay. I'm always curious as to what type of documentation would you need for a reverse mortgage if you're looking at the equity or the appreciation of the home, and if there's enough, what more would you need? But that makes sense. So what other outstanding items are we missing here that we haven't talked about a reverse mortgage? We know that there's some great advantages of a reverse mortgage. We've talked about what the benefit of why there's a great benefit of using reverse mortgage. And we've also talked about the benefit of even using reverse mortgage to purchase. I think that's phenomenal. In fact, I know I'm going to talk to my referral partners about the use of reverse mortgage, especially for those individuals who have a limited amount of investment that they want to spend, but they want to buy a better type of product, a type of home. So that's wonderful. So what other things can you come up with, Earl, that we haven't yet discussed?
Well, one of them would be an example where I tell you that I tell the clients the story, and I'll tell it real quick. Where did this all come from? And if you don't mind, it only takes about.
No, go right ahead. The hour is yours.
FHA came out with its product in the early 70s. And it was designed to raise home ownership. And we know that it worked, and it did. It raised home ownership levels. So in 1980-81, the Reagan administration says to this group of very smart mathematicians, hey, you guys, would you create a program for seniors to help them? Now, we helped those who needed help in qualifying with the FHA program on a regular loan. Can you come up with something to help seniors? And we want you to do these things, which is what we have today. They said, sure, we'll be back in no time. Well, it took 7 years. So no time kind of got stretched out. But the point is they burnt through a lot of number 2 pencils to get this thing right. And they did it. So it comes around in 1988. They based all of their predictions on where the economy was going from World War II to the 1980s. You would think that's plenty long. That's about 40 years. Well, things should continue on for another 40 this way. Of course, no one warned them that in that 2008 and 9, we were going to do what we did to the economy. But the fact is, they set this thing up. Now, keep in mind that when FHA first started its program, it did what? It collected mortgage insurance on a monthly basis, not unlike what you see with a regular, what we're calling a forward or conventional loan. Probably 50, 60 bucks a month in mortgage insurance, okay, back then. So it gets to be 1987, and I was selling real estate at the time, so I remember this quite well, because everybody said, well, that's it, FHA is toast. And the reason that they were toast was because there was a big fraud that occurred. And FHA got stuck with the bill, and it just about wiped them out. And so we said, well, there's no way they can recover from this. Well, somebody said, yes, we can. I tell you what, we're going to start a new way of collecting mortgage insurance. We're going to collect it like you call a prepay. So we know you're going to keep the product for a while, so we're going to collect a big chunk of that premium right up front. And today, I think it is still what the standard is 1.75%.
It is.
And with the reverse mortgage, it's 2%. And that we were talking about earlier about people, why they are so expensive, is because of the upfront. Now, when the kids are buying, we seem to be okay with it. And it isn't just kids that can use the FHA, I know that, but it's typical for them. So we think that's just fine. Well, with the senior goes, well, I haven't paid mortgage insurance my whole life since blah, blah, and I don't want to pay it now. Well, without that, the investor doesn't have that guarantee, do they? That they know they're not going to get, they're going to get their money back. The estate, the family, the borrower, they're not going to get on the hook for anything, because if it was upside down, the fund pays it. So that 2% saved the program. So there they are collecting it. And then we came into what? 2008 and 9. Had they not been doing that, the program would have never survived. And as it were, during the early 2000s, you were seeing what? Appraised values that were slightly higher than maybe they should have been. All right. And on top of that, people could get 20% more available to them than you can today. Now, why did they change that? Well, turns out that wasn't a real good way to doing business, because when the economy rolled over then in 2008 and 9, there were a lot of these, you might say, overextended. They shouldn't have maybe praised that high, maybe shouldn't have let them have that much money, because now it flipped real easy. So anyway, the point is in 2010, 11, and 12, HUD was writing checks quite a bit. And that was about the time they discovered some of these were coming about because people couldn't pay the real estate taxes. So 2013, they changed the program. Now you qualify for credit and income. And so these tweaks that they've made were to beef the program up and make it better. So here we are in 2023. The program has never been this strong. They've got kind of a wave, you might say, from, well, think about it. Back in the 2000s, when I just said this, when it first came out, you only needed two things. You needed a birthday and title to your property. End of story. You could do an appraisal, but you didn't have to qualify for income or credit. So it was just amazing how that turned out. So now all of a sudden, they realize you can't do that. Those were stated loans, no doc loans. That's what they were. Anyway, that gives you the story. How did it all come to play, and where did it come from?
That's great. I mean, that's good history, because I didn't know the beginning or how it was created, and I didn't know of all the. I knew that Ronald Reagan was the one who helped to create it, came up with the idea, but didn't realize all the history behind it. I think that's marvelous to see that. So we've already talked about the advantages, what goes into it. So why, other than the upfront mortgage insurance premium, is there a requirement to continue to pay the mortgage insurance premium on a month? No, it isn't, because you don't pay for a payment. You don't make a payment.
Right.
Yes. Yeah. Okay. So here I'm thinking about FHA loans and upfront mortgage insurance premiums and mortgage insurance premiums. So what are some of the misconceptions that you hear? Because I hear a lot of the misconceptions. I think we've talked about this a little bit at the beginning, but so all that you have to worry about if you do qualify for a reverse mortgage, you just have to make sure that you pay your homeowner's insurance and your property taxes every single year. And you have to live in the property for at least 6 months. Or what's the requirement for living in the primary home where the reverse mortgage is taken?
One day you can be out of your house 1 day short of a year. And then it's considered as probably not your primary home anymore. And how does anybody know that? I'll tell you. They send you a letter. We just got ours in the mail yesterday, so we just went online and answered it. What is it? It's a residency acknowledgement. They send out a letter that says, "Hi, how you doing?" Sign the letter, mail it back. So they know you're there, right?
So if the letter actually goes directly to another property, it may be too late. I don't know.
Yeah, they kind of figured out that shouldn't be going there because you're going to the wrong place. So as long as it goes to that address and you answer it from there in a timely manner. I only had one person that I know of that ever, she was a hippie and she lived out in Illinois, way out in the middle of nowhere. And she was just fun. But she calls me up one day and she goes, "I had this guy come pound on my door." And he was, "Oh, you are here." Well, she'd gotten 3 letters and refused to sign any. That's just the government checking on me. I'm going, yeah, it was.
Well, that makes sense, though. I can see that. All right. So what happens if there's a couple that is, let's just give an example because this just came into my mind. A person applies for a reverse mortgage, but has a person that's living with them, but not married to them, and it's just a friend. Does that friend have to get permission to allow this person to get a reverse mortgage?
You mean I'm assuming that you're suggesting that they're both on title?
No, they're not. Because I had an example, because I used to do reverse mortgages a long time ago. Yes, I've been in the business a long time. But I had to get permission from this individual who was residing in the same address. And it wasn't a son, it was a friend. Not a husband, but it was a friend. And the underwriter had me get a signed letter from him stating that he was giving permission to allow this person to get a reverse mortgage because it was going to cause a potential risk for him, for the property. If the property were ever to be sold, that he would have a risk of not being able to live there. I don't know if that's ever been the case, but I thought it was a very strange thing since he was not on title, but the underwriter wanted something signed.
It sounds kind of weird actually, because the only case we would have is if he was on title. If they're not on title, they can be put on title, but if they're not on title, they're just living there. Now we count it as a 2-member household, but everything's done in the name of the person who's entitled. We just ignore the other person.
Okay.
I've never had it where I had to go get a letter on that. Yeah, and I'm not saying you couldn't have an underwriter do that. It's not going to be required.
Well, I thought it was a rather strange request, and I asked them to just give me the page number of the FHA guidelines as to why I needed to do it. But anyway, she did say it was an FHA requirement, and of course, knowing me, I pushed a little bit harder and I didn't do it. So it didn't make any sense to me, but for some reason she required it. But anyway, so we already talked about that. So is there anything else more what are some of the costs other than the upfront mortgage insurance premium? What are other costs involved in getting a reverse mortgage?
Good. Okay. Well, let's just do this because let's stay with that for just a minute, and I'll give you an example. And we do a seminar that we do twice a month, and I always use the same example. People say the costs are so high. Okay. So what you have to do is, in this case, the person's house, he was making payments that equivalent were $18,000 a year. Okay. And as it were, his payments were about $22,000 a year. Excuse me. $18,000 in costs to do the reverse mortgage. His payments were $22,000 a year, principal and interest. Now, this is something a CPA taught me. He said, listen, this is how you have to calculate. This is about 10, 12 years ago. You've been in the business forever, and somebody always comes up with something that helped. It helped me to understand how to explain it to someone. Okay, so go back to this. So what we've got costs that are $18,000, but they're saving $22,000 a year in payments. Okay. And this sounds like, wow, that's crazy. No, it's not. You would take your monthly payment and you multiply it to make it an annual payment. And then you compare it to the cost and divide it. And what we came up with was this. In that case, the person was going to save $18,000 a year by making a $22,000 equity investment in the transaction. You took $22,000 from the house, and that's paying your closing costs. In that case, every year, as long as they lived there, they didn't have to make an $18,000 a year payment. Divide the two, and he says, that's a return on investment. What's the percentage? Well, it's crazy. Every year, you went to your financial planner and you said, I'm going to give you $22,000, but I want you to give me $18,000 in return, dividends every year. Oh, and by the way, make the 18 tax-free. Oh,
wow.
And he goes, that's true of any refinance, whether it's a forward or a reverse or anything. Take the cost, annualize it, divide it into your cost. Your payment. So if you're paying $1,200 a month, it'd be $14,000 a year. And so the reverse mortgage costs in that case, $18,000, we'll say. But still in all, it's way over 75% return. It's not uncommon to see anything from 35 to 75% return on investment. That's every year. And you say, yeah, but if I'm not making a payment, my equity is getting all chewed up, because we want to go to legacy thinking. And that's normal too. There's nothing wrong with that. But the fact is, I've had somebody do that, and I said, listen, so there's two things to that. So first of all, we said they lengthened it. We have to have more equity in here, because they don't want to use all that equity up. Why? Because it's like it's an insurance plan. You have insurance on your car, but you don't want to file a claim because your premium goes up. Well, they don't want to have to file a claim on this either. So you can't have access to any more than a certain amount based on your age. We talked about that earlier. How do you calculate that? So leave a margin in there. So the fact is that they're not going to be able to use all those dollars up. So over time, if the house was worth, I don't care, say it was $500,000, and you had a $250,000 reverse mortgage because of your age, that's all you could get. So you got all the money. So your reverse mortgage has maybe a 5 or 6% rate on it, and your house is maybe 3%, 4%. Think of how the difference in the numbers are. If you went like this, how long would it take for that to catch it? A long time, because the house is a bigger number. So the reality is, mathematically, it likely won't. The one you heard about where they took the loan out back in 2004, remember what happened? The value was overstated. The dollar amount was much greater. And they never did anything with the darn thing. They let it sit. Because you can refinance a reverse mortgage. If you've got a current reverse, whether you did it with a purchase or whether you did it on I paid off my Wells Fargo loan, I don't have a payment anymore on a refi, go down the road a year later, and if it were that maybe your values in your area jumped up, maybe interest rates dropped off, just like a regular loan, it might be that you could refinance that reverse and access more dollars again down the road. So you can do what we call a HECM to HECM. It's just a refinance of a reverse. You could do that.
So what's the time frame that you have to wait before you do a HECM to HECM?
It's 1 year.
1 year.
Just 1 year.
So talk a little bit about negative amortization. You may have spoken a little bit about it, but can you describe what negative amortization is all about as it pertains to a HECM?
Well, what it means is that the interest that's due, you're not making a payment, so it's being added to your balance. Okay, so each month that you don't make a payment, you get a statement. Try this. You've got a statement coming in the mail. We all get one. And draw a line down the middle of the paper. Left side shows your balance. So each month you'll notice, if you're not making a payment, that the balance is just creeping up. Why? Because you're not making a payment, they're adding the interest to it. Also, they're adding, and we didn't bring this up before, we will now, we said you paid the lump sum FHA premium in the beginning, then after that it's 0.5% per year on the remaining balance collected monthly. So two things are being added. One's the interest, the other one's that monthly. So here you're seeing that creep up. Now, if you had a line of credit on the right side that shows what that balance might be available to you. So you got the mortgage balance and whatever I might have over here. So I can draw from that line of credit. We talked about that. And if I draw from that line of credit, I can also put it back in there again and draw it again. So it's revolving. That's another important issue, that it does allow you to utilize it as a financial tool. Financial planners are just now learning that is another way to do it. As far as where can I put some of my money? I could put it in this line of credit. And it's guaranteed, meaning it's insured by FHA. So anyway, you go back to this whole thing about how there's that negative amortization. You can see monthly what it's doing. Say you came up with, I don't know, maybe you were good at the casino and you won some money, or maybe Aunt Agnes passed away and gave you $5,000. What do I do with it? Well, one place you could put it is back into the house if you wanted. And remember, that line of credit doesn't stay stationary. It grows tax-free at 0.5% higher than whatever the rate is currently on that line of credit, which today that would be, say 6.5 on the mortgage balance. So it means the line of credit's growing at 7% tax-free. So next month, that number got bigger too. So you now have this, and this is almost sounds like craziness, except it's been around since 1988, and folks just haven't what? Ask the right people the right questions to find out, is there something here as a tool that's really going to help me in my retirement? Well, here it is. Like Jack said, get out there and tell everybody.
Well, I'm so grateful for this information because you've enlightened me and educated me a lot more about reverse mortgages. And now my thinking is going really fast, and I know what I plan to do with that information, and that's really to broadcast it out to everyone. And that's the purpose of my doing this video, doing this Zoom meeting with you, because I wanted to get more information, because I was getting a lot of questions and calls about it. And I thought it was a great topic to talk more about. And I really thank you for it. Do you have anything else to add? Were you going to, anything that you'd like to add to what you've already given us today?
I'm trying to think if there's anything that we've missed, because we've covered a lot in here. And actually, for some people, it's almost too much. You go, hold it just a minute. Well, and I will say this, out of that, I mentioned that we've closed over 1,300 loans, and I'm very proud of this. Not one person has ever called up to say they made a mistake. If they call up, it's to say, this is the best thing we ever did. Why didn't we do it sooner?
I do have a question. So a person has a reverse mortgage, and for whatever reason, the person dies with the reverse mortgage. How do the heirs resolve that? Can they continue to make payments into the reverse mortgage, or do they have to sell the property and pay off the mortgage company?
That's very good. And we get those all the time. And by the way, we're here way past. We close today, we're here in the future. So when something like that happens, call us, we'll give you a hand. Here's how that works. So mom passes away. Okay, now the house is empty. There's nobody there. And the family has no intention of keeping it, although they can. And all they have to do is pay off the balance, and they own the house. Just pay it off. That's all you got to do. All right, so mom passes away. How long do they have to, maybe they want to go do some painting or fix it up or something. How much time do I have to do this? You have 9 months. They followed the same rule as the IRS rule that says you must file your final estate tax return. That means if it was mom and dad died, you don't do it then. When mom passes away, that's the final one, okay? IRS says you have 9 months from the date of the death certificate to file that, or else they're gonna come and grab the property or whatever. But the point is you got plenty of time. So they follow that one when you call, and what happens is I tell people, remember that mortgage statement I talked about? Up in the upper right-hand corner or down the lower left, there's a customer service number. You call the servicer and say, mom passed away and we're going to sell the house, or you're going to buy it, whatever way you want to go. The servicer, depending upon the file and the servicer, may or may not require the family to, and the family has to pay for it, but the investor pays, they order it, an appraisal. Well, why would they have to do that? Well, so someone doesn't say, there's a $200,000 balance, and the family goes, but it's only worth 150. Well, that means that they're making FHA pay the 50. They want to know what the value is for sure. And then you can list the house and sell it, or you can buy it, either way. Real estate agents, all right, have people call up and say, mom's had this thing for so long, it's underwater. This is one where they got it back in the early 2000s, okay? So the house is underwater. Why would the family care about the house at this point? There's nothing in it for them. I said to the real estate agent, I said, you have a guaranteed listing and sale here. It's going to sell for some price, depending on condition, location, all of that. We know that. So you're guaranteed to get a commission, because it would sell within the range of that appraisal. Oh, the appraisal is going to state the same thing, right? So if the house has some things to do, they're going to appraise it as is and say, well, this has to be done. But the point is that real estate agent has a guaranteed sale. He said, well, what's in it for the family? Take them to Texas Roadhouse. I don't know. As a favor. But you could take it. The family can just simply do what they call deed in lieu thereof. In other words, they just give the keys of the house to the lender and say, you guys take it and run with it. We don't want anything to do with it. They can do that too. But why would the agent, come on, you guys, I'll do this for you. I'll make a few bucks. We go fishing, whatever. But the agent has an opportunity to get a sale there. So does that help?
That's great. All this information has been really valuable and very worthwhile. I got a lot of good information, good knowledge. It was great, Earl. And I really thank you so much for the opportunity to speak with you about it. I love always referring my clients to you, and I'm going to become a little bit more knowledgeable about this product now. In fact, a lot knowledgeable about this product now. So I really appreciate your time and effort and helping me to get this out to the public so they can understand what reverse mortgages are really about.
Thanks for asking me to come over and chat with you today. That's great. It was fun. Thank you.
Yes, great. So when do you have your reverse mortgage seminars?
First Thursday and the third Thursday of each month at 2 p.m. Central.
Wonderful, wonderful. Well, I will definitely. Is that open to the public, or is it the Zoom? Or
no, it's a Teams meeting. But if someone says they want to bring someone to it, they can. And we have CPAs, realtors, LOs. In fact, one CPA said I sent 2 clients to come listen to it. It covers everything in 45 minutes. So where we kind of, we're able to elaborate today because we have a little more time, but it runs about 45 minutes. So generally speaking, pretty much what you heard here, you'll hear there, with a little bit more extension on certain topics.
That sounds great. Again, thank you so much. I really appreciate your time, and this was fun, and this was very enjoyable and very informative, and I really appreciate your time. Thank you so much, Earl.
All right, take care. We'll talk later.
You bet.
Bye-bye.
Thanks for watching today's video on reverse mortgages. I hope that I was able to provide you with valuable insights and clarify any misconceptions you may have had. Remember, a reverse mortgage can be a useful tool for some, but it's important to fully understand the risks and benefits before making any decisions. As always, if you have any further questions, please don't hesitate to reach out to me in the comments section below. Until next time, take care and stay financially savvy.